Hello, lovely viewers. Welcome back to Mindful Finance, your go-to channel for all things finance with a mindful twist. During the initial phases of my journey in the stock market, I lost a lot of money. I can say that. Everybody would have gone through this phase. I tried all type of instruments. I have traded in options. I have traded in equities. I have traded in mutual fund. I have traded commodities like crude oil, gold, everything. I have tried everything. If you give me 10 lakhs rupees, I can handle my trade and position very well. But if it goes beyond 10 lakh, emotionally, I'll get weaker. I'm not good at handling more money. I can frankly say that trading is not everybody's cup of tea. One day you need to identify, understand your strength. If you are able to handle, then you can take a foot in the stock market in trading. But I know technical analysis. I know fundamental analysis. I know the strategies to play with the options. I can confidently do virtual trades and show the people that, see, if you would have taken this trade, you would have got this much of profit. But when it comes to real money, you need a different mindset. That mindset is very important. Frankly speaking, I don't have that mindset. But it's my personal choice to do that. But within the limit of money, I can handle my trade. But if it goes beyond that limit, I cannot handle the trade. I have money management. I know the risk-reward ratios. Everything I know. But everything within my limit. If it goes beyond certain limit, I cannot handle it. So understand your limit. Understand your strength. Understand your risk and reward ratio and your risk tolerance and your long-term goals. And make a right choice. Do a mindful decisions. I am Sundar, and today we are going to delve into some common investment mistakes. And most importantly, so our first mistake is investing without clear, well-defined goals. Let's face it, without specific goals, your investment strategy can be like a ship without a rudder. You're just drifting. Here's the solution for that. Define clear goals. Make them specific, measurable, achievable, relevant, and time-bound. Think about what you want to achieve, like buying a house or planning for retirement. Assign monetary values and time frames. It's like creating your own financial roadmap. Next, align your investments with those goals, whether it's short-term, medium-term, or long-term. There are suitable investment options, safety and liquidity for short-term goals, a balanced approach for medium-term goals, and wealth creation for the long-term goals. Regularly review and rebalance your investments to ensure they are on track. And here is a gem of advice. Consider using SIPs, systematic investment plans, to stay disciplined. It's like a financial fitness routine for your money. So everybody would have talking about SIP, but don't take it as a joke. Just to give you a taste, imagine saving for your child's higher education. Starting an SIP in a diversified equity mutual fund can help you reach that goal, even with a modest monthly contribution. But remember, it all starts with clear goals. By aligning your investments with your goals, you are setting yourself up for financial success. It's like having a compass in a vast sea of options. The second one, chasing past performance. Our next mistake is chasing past performance. Too often, investors fall into the trap of thinking that what performed well in the past will do well in the future. But that's not always the case. Here's how to avoid this pitfall. Assess the consistency of performance. Don't just look at the past year. Look at how the fund has done over different market cycles. It's like checking a car's track record on a various terrains. Consider risk-adjusted returns. It's not just about high returns. It's about how much risk the fund took to get there. Think of it as a risk-to-reward ratio. And of course, don't forget to evaluate the fund manager's track record. The captain of the ship matters. If they have been navigating rough waters successfully, that's a good sign. Understand the investment strategy. Know what the fund is actually investing in and whether it aligns with your goals and risk tolerance. It's like knowing the route before you start a journey. Imagine investor A blindly chasing high returns without considering risk, and investor B who looks beyond the surface. Investor B is more likely to have a well-rounded portfolio in the long run. So folks, don't just follow the crowd. Don't have a herd mentality. Take your time to evaluate funds based on various factors, not just past performance. Now, the third one is overlooking expense ratios. Now let's talk about a mistake that often goes unnoticed. Overlooking expense ratio, which means these little numbers can have a big impact on your returns. You may feel it's a very less amount, but in the long run, it may affect your entire portfolio. First and foremost, understand what the expense ratio is. It's like knowing how much you are paying for a service. It's like the annual fee charged by the AMC. It's like a subscription fee or something. Choose direct plans if possible. These plans have lower expense ratios, and because they don't include distributor commissions, it's like buying a product directly from the manufacturer and bypassing brokers and third party. Use online platforms to invest in direct plans. It's convenient and cost effective. Just think of it as online shopping for your investment. Every service provider will have their own portal, so where you can directly go and invest the direct funds. Always compare these expense ratios. Lower costs can significantly boost your returns over the longer durations. It's like finding a discount during a sale. Picture investor A investing in a fund with a high expense ratio and investor B choosing a direct plan with a lower expense ratio. Over time, investor B's growth more efficiently. I'll just show a sample for you. You can compare this and you can identify what is the difference between this and how much you may profit from choosing a direct fund. Remember, every rupee saved on expenses is a rupee earned in returns. So be mindful of those expenses. The fourth one is neglecting diversification. Let's talk about a classic mistake, neglecting diversification. It's like putting all your eggs in one basket, which can be a risk. So whenever you talk about stock market investments, this word you would have heard multiple times, which is don't put every egg in the same basket, which is you need to diversify across AMCs. Don't put all your trust in one management team. Diversifying across different AMCs speeds the risk, which means don't buy mutual funds from same service provider. For example, if you are buying from ICICI, don't buy all the funds from ICICI. Diversify across sectors. Don't bet everything on a single sector. Diversify across various sectors to reduce the impact of sector-specific downturns, because the market has cyclic nature. Every sector has a rotation time. Diversify across asset classes. Don't just stick to one type of investment. Mix it up with equity, debt, and maybe some gold to balance risk and reward. Sometimes you can consider for hybrid funds for balance exposures. These funds do the diversifications work for you. It's like having a professional chef prepare a diverse meal for you, like a buffet. But some people may disagree with hybrid fund, but that is okay. It's a personal choice, but it's all about diversifications. If you can wisely able to select or choose your funds, it's well and good, but it's not bad to choose hybrid funds. So think of investor A, he invested all in on tech stocks, and investor B with a diversified portfolio. When the tech sector takes a hit, investor B's portfolio remains steady. Think of an investor A who invests everything in tech stocks, and investor B diversifies his portfolio. But whenever the tech sectors take a hit, the investor B's portfolio may look like remain steady, and the investor A might be looking in a deep hole. Diversification is like having a safety net for your investments. It's all about reducing risk and increasing resilience. Today, IT sector might be low, but at the same time, metal sector might be high. Same in another 3 or 6 months down the line, the same thing will change. IT may come up and metal may go down. So don't just focus on one sector. You have to diversify your portfolio. That is the key essence of this one. Timing the market. Timing the market. The ever elusive dream of buying low and selling high. But it's a mistake that even seasoned pros struggle with. It's not an easy job, guys. Don't ever try to find or predict when the market will go low. Instead of timing the market, consider SIPs. They are like your financial GPS, which I keep on telling you, keeping you on the right path regardless of market conditions. Even in my previous video, I'll give a link over here. I have described about how wisely you can invest in SIPs, which can beat inflations and which can beat normal investors. Benefit from rupee cost averaging. SIPs help you buy more units when the prices are low and fewer when they are high. It's like getting discounts when the market is down. So think long term, stay invested for long haul. It's like planting a tree. The best time to do it was yesterday, and the next best time is today. It's one of my favorite quote. Don't forget regular reviews and rebalancing. It's like fine-tuning your investment strategy for the best performance. So picture investor A try to time the market and investor B who embraces SIPs, the long-term approach. The investor B tends to have a more peaceful investment journey than the investor A, who keeps trying to find or keeps the right time to invest. Timing the market is a game, few only wins. SIPs, rupee cost averaging, and patience can be your best friends in the world of investing. That's why I keep on telling you, mindful finance, ignoring risk tolerance. Now let's discuss ignoring risk tolerance, a mistake that can keep you up all nights. I keep on telling you this simple thing. If you are not able to sleep the night, that means you have a problem in your investment strategy. So assess your risk tolerance. It's like knowing your own strength. Understand what you can handle emotionally and financially. Diversify based on risk tolerance. Allocate your assets wisely among different risk levels. It's like building a balanced diet tailored specifically for your health. Or if you are going to gym, what are the things, proteins or whatever you need, right? It's like that. So align your investments with financial goals. It's about having investments that match your own goals, like wearing the right shoes for the right occasion. Regularly review risk tolerance. Life changes, and so should your investments to reflect those changes. Visualize investor A investing aggressively despite a low risk tolerance, and investor B who is in tune with their risk level. So investor B is more likely to sleep well at night, which is very important in your investment journey. Ignoring risk tolerance can be a recipe for financial anxiety. By aligning your investments with your comfort zone, you are setting yourself up for peace of mind. That's why I keep on telling you mindful investment. Mindful is the keyword over here. Avoiding research. Next up is avoiding research, a common mistake that can lead to financial decisions you will later regret. Even for a small trip to travel, we do multiple n number of researches, reviews, feedbacks, photos, everything. Understand the investment strategy. It's like reading the instruction manual before assembling furniture so that it prevents frustration later. If you don't know what you are doing, then please don't do that. Find a suitable person or find an expert from that and hear from them. Evaluate the fund holdings. It's about knowing what's inside the box, or in this case, the fund. Review the portfolio to assess the quality and diversity of the assets. Use some reliable research platforms. These platforms are like having a trustworthy friend who gives you honest advice. Consider the fund manager's track record. It's like checking a chef's restaurant reviews before making a reservation. As I mentioned, like your travel trip, you have to review or go through all the reviews and feedback of that AMC manager. Imagine investor A blindly investing based on recommendations and investor B who does their homework. Investor B is more likely to make informed decisions. A simple thing, right? So research may take time. It might be a boring activity, but it's an investment in your financial well-being. It's your money. Knowing what you are getting into can save you from unpleasant surprises. Sometimes this boring activity will give you happiness in the later point of your time. You'll feel proud of yourself that you have done so much good in the research and you picked the right mutual funds and you have created this wealth based on your own research. That will be the proudest moment you will ever have, which I have faced personally. Frequent trading. Oh man. Last but not least, frequent trading. The mistake that can eat in your return faster than you say buy. Stay invested for the long term. It's like letting your garden grow instead of digging up the seeds every day to check. Like after planting a seed, will you go and check every day, dig and check every day, or what is there? What happened? Will that seed grow then? Nowadays, everybody is doing that same thing. Every day they'll open the app, keep on checking what is happening in the market, how much it fall, how much it went up, or today it went well, but nice. Today it dropped. Oh my God, it dropped. I should have sold it. Right? How many of you are feeling in such a way? So understand the costs involved. So frequent trading can lead to exit loads and taxes as well. It's like paying tolls every time you change the lanes. And also consider tax implications. Knowing the tax rules can help you make more tax efficient decisions. And the very important one is avoid impulsive decisions. Stick to your plan. It's like sticking to healthy eating plan instead of binge eating on junk food. And regularly review your portfolio. Make adjustments based on your changing goals and market conditions. Just to interpret this one, think of investor A who is frequently trading and incurring costs, and investor B who stays on the course. Over time, investor B's portfolio is likely to grow more. If you go and check the investor A's, his P&L statement will show more money spent on taxes and the GSTs, STTs, all those kind of things. So frequent trading can be costly and counterproductive. Staying invested, understanding costs, and avoiding impulsive decisions are keys to long-term financial success. And there you have it, folks. 8 common investment mistakes and how to avoid them. Remember, investing is a journey, not a sprint. Stay mindful, stay informed, and you'll be well on your way to financial success. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell. Until next time, stay mindful and invest wisely.